Let's move on to day 7 of our Dekmar Trades Bootcamp. We have gone over our foundation. We have been working our way into different candlesticks, different strategies. And today I want to be talking about something that is extremely important, guys. And what that is indicators. What are indicators? Why do we use indicators? What are the indicators that I like to use? Now, everything I always use, everything I always say, I like to back up with credibility. So if you guys do have any questions, something I may not cover, you guys are always more than welcome to ask me to make sure that you guys have a 100% understanding about these indicators, why I use them, and the meaning behind the indicators. So the first things first is, what are stock indicators? Well, stock indicators, guys, are technical indicators, are critical mathematical calculations based on price, volume, or open of interest of a security on contract by traders who follow technical analysis. And that's what a lot of these indicators are going to be, guys. They are based off price, volume, but a lot of them, guys, are going to be able to be helpful just from that trader mindset, because traders are using that technical analysis and trying to figure out where could price targets be, where support's going to be, where is resistance going to be. So stock indicators are going to be another line along with our support and resistance. And as we know from our previous lessons, there are 3 different types of support and resistance. We have our natural, we have our detailed, and we have past chart history, right? These stock indicators are just going to be other areas where we can look to buy, where we can look to sell, where we can look to bounce them off support, where we can look to sell them up at resistance, or again, be able to see different breakouts or, breakdowns. And that's what the main point of these stock indicators are. Now, if we want to get into indicators and the different types of indicators, there are 2 different types. There are going to be overlays. Now, this is when we're looking at a chart, guys. Imagine looking at a chart, and when we're putting on different indicators to our charts, there's 2 different ways that we can do that. Number 1, we have overlays. We have technical indicators that use the same scale as prices that are plotted over the top of prices on a stock chart. Example including averages and Bollinger Bands, which we'll go into be diving in. We're going to definitely be talking about averages soon. And we have oscillators. These are technical indicators that oscillate between a local a minimum and maximum plotted above and below a price chart. Examples would be the MACD or the RSI. So what we are going to be talking about right here for our overlays is we're going to be going over moving averages. We'll touch up a little bit on our Bollinger Bands, and the same exact thing with oscillators. If you guys want an example of that, we're going to be talking about the RSI. I do use the MACD sometimes, but it's not as much. And that's the thing I want you guys to understand. These indicators, I'm going to teach you which ones are the most popular. I'm going to teach you guys which one are the most powerful, but I want you guys to try many different indicators because it ultimately does come down to preference. What works best for you? If you find that this indicator works great for you and you're making money on it, that's great. Keep using it, right? Because no one can come up and tell you, oh, you shouldn't use that indicator. It's not a good one. And you say to yourself, well, I've been making a ton of money at using this indicator. Keep using it, right? So if you have one of those special indicators that you continue to use and you continue to make money, don't let anyone ever tell you any different, all right? So let's start diving into what indicators do I like to use? What are some of the very popular ones? Well, one that is an absolute must is going to be the moving averages, which are the 50-day moving average and the 200-day moving average, guys. So first thing, what is a moving average? A moving average is simply an arithmetic mean of certain numbers of data points. The only difference between a 50-day moving average and a 200-day moving average is the number of time periods used in that calculation. The 50-day moving average is calculated by summing up the past 50 data points, then dividing the results by 50, while the 200-day moving average is calculated by summing the past 200 days and dividing the results by 200. Now, something that's very big that obviously is standing out on this chart is what? We only use certain indicators on certain time frames. So the 50-day moving average, the 200-day moving average, some of the other ones that we're going to be going on, we're only going to use these on the daily chart. Now, why? Why would we only use these on the daily chart, guys? Well, this is where the majority of traders are going to be using these moving averages. If we have them on the daily chart, that's going to get us a great understanding about where people are going to look to buy, where people are going to look to sell, where people are going to be, looking for a little bit more volume, or where things could be a little bit slower. If we use them on the 1 minute, the 50-day moving average and the 200-day moving average are going to change in price. If we use them on the 2 minute, the 50-day moving average and the 200-day moving average are going to change again in price. If we use the 50-day and 200-day moving average in 3 minutes, it's going to be different than what was on the 1 minute, was different than what's on the 2 minute, different than what's on the 3 minute, different what's on the 5 minute. So there's too many different options there. So what I always like to do, break it down to the simplest form. Imagine if there's 100 people in the stock market. If there's 100 people in the stock market, what do you think, people are using the moving averages? Well, let's say 10 of them are using the 50-day moving average on the 1 minute chart. 30 of them are using the 200-day moving average on the 3 minute chart. 20 of them are using it on the 5 minute chart. And everyone's on different time frames. Well, everyone's going to say, oh, wow, resistance coming up on the 50-day moving average soon. Everyone look to sell. And it's like, well, that's not my moving average. Oh, well, what time frame are you on? Oh, I'm on the 1 minute. Oh, well, I'm on the 3 minute. Okay, well, my 200-day moving average is actually holding up as support soon. Oh, my 200-day moving average is all the way down here. Well, what time frame are you on? Oh, I'm on the 3 minute. Oh, well, I'm on the 5 minute. So there's too much confusion there. So do people use the 50-day and the 200-day moving average on the 1, 2, 3, 5 minute charts? Yes, but the most popular one is going to be where? On the daily chart. And the most popular one is going to lead to the most strength. So if there's 100 people in the stock market, and we know out of 100 people, let's say 75 people use these moving averages on the daily chart, well, what do we know then? We know the majority of them are going to have the same numbers that we have. So if we're coming up to the 200-day moving average, a lot of people are going to look to sell. And if we're coming down to, let's say, the 200-day moving average, a lot of people are going to look to buy, maybe a bounce play off. And if we're coming up to the 50-day moving average, a lot of people are going to look to sell. And if we're coming down to the 50-day moving average, a lot of people are going to look to buy, right? So that's why we always want to be on the correct time frame. And these moving averages, they're going to work the best. They are going to be the strongest on the daily chart because that's where the majority of people are at. Now, as I say, I've been saying this in a lot of lessons, guys, it does come down to the mind of stock traders, understanding the mind of stock traders, right? Stock trading, especially penny stocks, they are moved based on which way buyers are currently looking, or excuse me, how many buyers there are to, about how many sellers there are. If you wanted to trade Apple, Apple, a group of traders can't move, Apple very much, right? Maybe like not even 1%. But a group of traders can move a penny stock very sharply up or down. So what I always say, as I've said before in the past, when you sit down every single day in your chart or in your seat, you don't say to yourself, what am I going to trade today? You say, what is everyone else going to trade today? Now, again, we're carrying over that same exact mindset as we're looking for moving averages. It's not what's my favorite moving average. A lot of times we're saying, what is everyone else's favorite moving averages? The reason I use the 50-day and the 200-day moving average is because they are the most popular moving averages there are. So if they are the most popular, that means when people move up to the 50-day moving average, it holds up as resistance. And when people come down, it holds up as support. Vice versa with same exact thing with the 200-day moving average. So the reason I use these moving averages is because they have the most force, because they are the most popular, and because everyone has the same game plan, I'm able to get one step ahead of the game and be able to say, all right, I want to sell, come on up. I want to bounce coming on up. So I just want to make sure everyone is understanding that. Now, when we have our 50-day moving averages, let's dive into these and let's talk about these a little bit more. So 50-day moving averages and 200-day moving average. Our simple moving average, SMA, are often viewed as low-risk areas to place transactions since they correspond to the average price that all traders have paid over a given time frame. For example, a 50-day moving average is equal to the average price that all investors have paid to obtain the asset over the past 10 trading weeks or 2.5 months, making it a commonly used support level. So if a stock goes on a big time spike and we start coming down to the 50-day moving average, it's a low risk area to buy because this is the moving average. This is the average of where it's been the last 50 days. So most likely, even if it does go below that area, it's going to probably pop back on up at that area at some point as well. Similarly, the 200-day moving average represents the average price over the past 40 weeks, which is used to suggest a relatively cheap price compared to the price range over the most of the past year. Once the price falls below this average, it may act as resistance because individuals who have already taken a position may consider closing the position to ensure that they do not suffer a large loss. So when we're underneath the 200-day moving average, it holds up as resistance. And now again, what type of resistance? Say it in your head. What type of resistance would a moving average be? Well, we have natural resistance. We are going to have past chart history resistance. And then after that, what do we have? We are also going to be having detailed resistance. Remember that, guys, right? Remember our detailed resistance? And detailed resistance would be any sort of statistic, anything we have to look up, right? It would be the open, the close, the previous high, the previous low, right? Anything along those areas. So, looking at the 200-day and the 50-day, this would be detailed resistance or detailed support. And as we already discussed, guys, we only use these moving averages on the daily chart. So let's get some examples of this so you guys can get a visual and get a nice understanding of what we're looking right here. Well, here's an example, VLRX. VLRX, if we're looking back at this play, we see VLRX back in February. This blue line right here represents the 50-day moving average. Now, all these charts, guys, are from stockcharts.com. It's a free website that you guys can use to go ahead and do your charting, right? And if we're looking at VLRX, this blue line is the 50-day moving average. And if we look, we could see we bounce off the 50-day moving average. We bounce again off the 50-day moving average. Once we fall underneath the 50-day moving average, it hits it and holds up as resistance. Then we come back up to the 50-day moving average. We hit it, it falls back on down because it holds up as resistance. But I want you guys to understand how we can bounce off of it when we're above it, and if we crack underneath it, we can hold up as resistance. It's just another support and resistance line, and that's what I really want you guys to get. These moving averages are just another support and resistance line for us to gauge where we can buy and where we can sell. Look at this right here, the 50-day moving average. We can buy, and where do we want to sell it? At the 50-day. Let's say we buy it right here. We see it spiking, sell it at the 50-day moving average. Buy, sell, buy, sell, buy, sell, buy. As the stock spikes, we did get a nice little breakout, but what happened? It started dumping on underneath it, and even when it tried to spike right here, it got rejected at the 50-day moving average. 50-day moving averages, 200-day moving averages, they're all just, in my head, different sell targets. They're either where I can look for a possible sell target or where I can look for a possible bounce play. That is the 50-day moving average. Now, it's the same exact thing with the 200-day moving average, guys. And I know this one's a little bit harder to see, right? It's a little bit more tricky, but we can see the red line. The red line represents the 200-day moving average. In the 200-day moving average, we can see it runs up right here and gets rejected. And it runs up here and gets rejected. And it runs up here and gets rejected. Now, finally, we break above it. And look what happens. It bounces and bounces and bounces, and it falls underneath and gets rejected, and it falls all the way back on down, right? So we can even see, some of this stuff on examples, today. I believe the stock that we were playing today, what do we have right here? Hold on one second. Trade idea seems like they're acting up just slightly. Let me go ahead and re-upload these. So if we're looking at our top gainers today that everyone's looking at, let's see DMPI right here. DMPI, we could see back here on these charts, right? DMPI, we could see this stock ran on up, right? On DMPI, started fading all the way back on down after it hit the 200-day moving average. This stock right here ran on up and then started falling back on down after it hits 200-day moving average, right? So you can see right here that there is a lot of, easy areas that we know where to sell just because of what happens, right? Just because that this play ran up to that 200-day moving average. Let me put these right back on here. The big show, that's what we like to call it. Absolutely awesome. All right, so you guys can see that right along on DMPI. Now, we're probably going to refer to DMPI a little bit today for a couple different things because we want to go over a lot of the indicators. But we could see the 50-day moving average, 50-day blue line, we break it. That's a possible buy area because we're breaking resistance. We run up to the 200-day moving average, run up to the 200-day moving average. Resistance, resistance, resistance. Finally, we break the 50-day again, ran up right up towards around the 200-day moving average. So it does just give us a great area on where we can say to ourselves, hey, you know what? This is what we want to be watching. This is what we want to be focusing on. We want to make sure that we're all set with this play. And, it's a great sell target and great resistance lines to be watching. All right. So let's dive back in on this right here and let's see what we have. Two. All right. So next on up, we have the exponential moving average. So this is a little bit different. Before was the simple moving average. 50-day and 200-day moving averages are on the simple moving average. Exponential moving average is slightly different. So an exponential moving average is a type of moving average that places a greater weight and significance on the most recent data points. All right. The exponential moving average is also referred to as the exponential weighted moving average. An exponential weighted moving average reacts more significantly to recent price changes than a simple moving average, which applies an equal weight to all observations in the period. So, what do I want you guys to get from this? The most popular EMAs are the 13 and the 20. Now, I just use the 13, but you could use the 13 and the 20. Some people also say 12. 13 and 12 are basically identical, but some people like to use the 20 as well. Again, same exact thing, guys. We only use this on the daily chart, and what we like to call this is the flexible trend line. So we call this the 13 EMA, the flexible trend line. So this is always, very important, of course, for you guys to be watching and for you guys to be focusing on. Now, you guys may be able to see it on the charts right here. This is that green line. And it's the same exact thing, guys, that I carry over with my actual trading. If you guys are looking at DMPI right here, DMPI, we have our green line. So basically, I grew up, studying a lot of stockcharts.com, and I always just got in the habit. 200-day moving average is going to be in red, 50-day moving average is in blue, 13 EMA is always going to be in green. Now, why do I call it the flexible trend line? Well, basically, guys, it's going to be able to show us when stocks are considered bullish and when stocks are considered bearish. So, for instance, we know we have our trend lines, right? We haven't dove into our trend line lesson just yet for our boot camp lesson, but that's going to be coming up very shortly. And our trend line lesson is what? We have trend lines that go up through plays. If they're on the top side, they're bullish. If they're on the bottom side, they're bearish. And we're going to dive into this more coming up in the near future. But what I want you guys to understand is that is basically what this green line is, this 13 EMA. The 13 EMA, it's the flexible trend line, because usually trend lines are very stiff, very hard. They're basically one line from point A to point B. If you're above it, you can stay on the buy side. If it's below it, you want to be on the sell side or the short side. The 13 EMA here just shows us which way we want to be at on a more flexible scale. So for instance, if we're looking at IFMK, right? We're looking at IFMK right now. IFMK, this play, we are seeing as long as it's below this green line, it's bearish, which means you can hold it as a short. Let's say you see IFMK is bearish right here at $3.23. You can short this play. And as long as every single day closes below that 13 EMA, you know what? You are good to go. Now, did you get a little bit of a break right here? Yes, you got a little bit of a break right there. So that may scare you out. But you could see, 99% of it is what? Underneath, and then we cross right here. We cross right here. Now we're on the bullish side. And now we say to ourselves, hey, wow, IFMK, this is the first time we're crossing the 13 EMA, going from the bearish side to now the bullish side in a while, in a few months. Maybe I could pick up an entry here. So you pick up an entry at 95 cents, and you're good to hold. You're good to hold. Nice big spike, maybe sell up there. And then you maybe want to sell right here when it starts cracking a little bit. No matter what, you're still making profit, right? It gets a little iffy up and down through these parts. And then what happens? We go from the bearish side, we're bearish. Finally, again, like right here, we're back to the bullish side, right? Where you can see, as long as we hold this, uptrend, we're on the bullish side of the chart. And you could do this for a lot of different charts, guys. You could do this for a lot of different patterns to see how these patterns currently are, to see where they're currently at. Let's just, type in something else random, GEVO. Right? Bearish, crosses over, bullish. Okay, lock in your profit right there, right? Right now, currently, we are bullish, as long as that 13 EMA holds, right? One of the great ones, CBIO. CBIO, look at this play. As long as it holds that 13 EMA, you're considered bullish this whole entire time. So, CBIO, You buy in, right, let's say $5, you're good to hold, you're good to hold, you're good to hold, you're good to hold, good to hold, good to hold, good to hold. Maybe you start locking in some right here. Good to hold all the way up here. It went from $5 to $37, all because all you did was watch the green line, watch the flexible trend line, and it told you that you were still on the bullish side of this chart, right? So CBI, it told you that you're still on the bullish side of this chart. And that's, an absolute great thing. And that's how great the 13 EMA is. And as always, we have our 50-day and 200-day moving average as well. But, 13 EMA is just going to be able to tell us if this stock is, currently bullish or if this stock is currently bearish, and which way, of course, we should be looking at our possible, entry. Should that be long? Should that be short? Should I be getting out soon? Should I be continue to hold these plays? Right? And that's the great thing about it. There's so much, awesome things that you can do with moving averages. And there's so many awesome things, of course, that you guys can do with our moving averages and our simple moving average and our exponential moving average. So getting back to this over here, guys, we are going to be moving on next to our RSI. Now, as you guys can see really quickly, we have our exponential moving average and we have our 200-day moving average and our 50-day moving average. Notice on these moving average, what were they called? These were called overlays, where basically we are putting this, plotting over the prices of a stock chart. So that was our first ones, our overlays. And you could see the 50-day moving average on top of the chart, right? We could see the 200-day moving average on top of the chart, the 13 EMA on top of the chart. So what are other ones that we're looking at? Oscillators. Now, oscillators are technical indicators that oscillate between a local minimum and maximum, are plotted above or below a price chart. So they're not even on this chart. They're above or below. And these include like the MACD or the RSI. So if we're just looking really quickly, let's say we look at, this chart right here. Where's the RSI? Where's the MACD? Well, it's not right here. The RSI is actually these squiggly lines. They're above the chart. And where's the MACD? The MACD is actually below right here, these squiggly lines down here. So what does the RSI do? Right? What's the point of the RSI? Because that's the one we're going to be focusing most on. All right, so what does the RSI do for us? Where the RSI stands for the Relative Strength Index. All right, so that's what the RSI stands for. Now, what is the Relative Strength Index, the RSI? It's a momentum indicator that measures the magnitude of recent price changes to evaluate overbought or oversold stocks and conditions in price or of a stock or other assets. The RSI is displayed as an oscillator, a line graph that moves between two extremes and can have a reading from 0 to 100. The indicator was originally developed by J. Wells Wilder Jr. and introduced to his seminar in 1978 book, New Concepts in Technical Trading System. So let's dive into this and let's talk about it a little bit more. As you guys can see, this is also an indicator that we only use on the daily chart, right? So this is one of these things, again, we're using on our daily chart, and we're doing it because that's where it is the most popular. So the RSI, let's talk about it. Where is it? The RSI is up here. Now, when we look at the RSI, how can we understand it? How can we read it? Well, before, our moving averages were more for support and more for resistance, right? Knowing where to possibly get bounce plays, knowing where to possibly sell stocks. So what is the RSI doing for us right here? The RSI is telling us when a stock is overbought or when a stock is oversold. So let's break it down. RSIs are going to be 0 to 100, okay? So it goes from 0 to 100. But where the stock wants to be at all times is between 30 and 70. Anything below a 30 is considered oversold, and anything above a 70 is considered overbought. All right? So how can this help us? Well, let's put it in a different way. Imagine you guys are walking down Wall Street. A broker comes up to you and says, hey, I have a stock that you want to buy. Now you say, all right, tell me about this stock. And you say, well, it's an extremely overbought stock and it's probably going to fall soon. You'd say, no, I don't want to buy that stock, right? That's an awful stock to buy. Overbought means it's bought up too high. The stock is already too high. So what's going to happen? It's most likely going to come down soon. And if the stock is oversold, you may be able to get a bargain price on it, as the stock may be going to be able to move back on up, right? So when we're looking at this play right here, how can this help us? Well, we can look for an entry possibly every time it goes to the oversold side. And that means it's underneath the 30. So let's just go right here. If we're looking at this play, we could see it dips underneath the oversold side. And that's when the stock went down to $5. And traders saw that it was oversold. So what happened? It got buying volume and it ripped all the way up to $7. Right? Look how crazy that is. Right? Look at this nice drop. This dropped below a 30 and fell down towards around a 12 on the RSI. This stock again was around a 30, dropped down to a 12 on the RSI. So this big gap down right here dropped the stock from a 30 on the RSI to around a 12 on the RSI, right? And then guess what happened? The stock went from $2 and spiked all the way up to $9.50. And why did the stock go from $2 and spike all the way up to $9.50? Because it was extremely oversold. Buyers came flying in on this, which led to the stock running all the way up to a 70. And notice what happened when the stock ran up to a 70 on the RSI. Traders know that's where it starts to get overbought. So what happened then? That's where traders start selling it on off. So they bought it when it was oversold. They sold it when it became overbought. And then they just came back down to even. And we could look at that on all the charts we just went over. Right, guys? And that's kind of the crazy thing. Look at this, VLRX. Notice the stock. The stock went all the way down to around a 15 on the RSI when it was all the way down low right here. What did happen then? The stock went from around 225 and spiked all the way up towards around 375 because the stock was oversold, right? Look at the stock right here when it was above a 70 on the RSI. When the stock was above a 70 on the RSI, guess what traders did? They started selling it and it started coming back on down. But this is all on what? The daily chart. This is on the daily chart. And if you look at it on the 1 minute chart, the 2 minute chart, or anything along those lines, it does get a little bit more, a little bit more iffy because some people you'll be like, oh, Deck, the stock has a 75 on the RSI, an 80 on the RSI, 90 on the RSI, but it may not have that on the daily chart. So that's why it's definitely, a little bit more iffy to use on a 1, 2, 3, 5 minute chart, right? You need to be able to see it and be able to, on the daily chart, to see where it's really oversold, see where it's overbought, and then you can get a good judgment from there, right? So, very, very important, very important. The RSI, one of my favorite indicators, always right on top of your chart on a daily chart, and you can really get some good understanding about these plays. What else do we want to see? What else are we moving on to? Well, we want to be talking about the VWAP, right? VWAP, very important play, right? Where the VWAP is the volume weighted average price. That's what the VWAP stands for. The VWAP is the volume weighted average price. It's a trading benchmark used by traders that gives the average price of a security that has been traded at throughout the day based on both volume and price. It is important because it provides traders with insight into both the trend and value of a security. All right. Now, this is where we start diving into our 1, 2, 3, 5 minute charts. Now, why is that so great? Why do we use the VWAP on our 1, 2, 3, 5 minute charts? Because the price doesn't change, guys. That's what's the great thing about the VWAP. The VWAP, again, if we are on the 1 minute chart, let's say it's $2. If we switch the 2 minute charts, it's $2. If we switch to the 3 minute chart, it's $2. The 5 minute chart, it's at $2. If we're at the 50-day moving average and we trade it to a 1 minute chart, it's $2. If we change to the 2 minute chart, it's $180. If we change to the 3 minute chart, it's $298. It's all over the place depending on what time frame you're in. So that's why the VWAP is so great to use on your time frame because it doesn't change ever. So if we're looking back at DMPI right here, right, and we can add this VWAP. So we go to VWAP right here, and we could start. Let's go with the VWAP right here. Where are we at? 215. VWAP's at 215, 1 minute time frame. 2 minute time frame. Again, we're still at 215, right? We can go back to a 3 minute time frame. You can see we're still at 215. It doesn't change. And that's why we use the VWAP on our minute chart. So this is my average setup that you guys can see right here. So my setup, 13 EMA, 50-day moving average, 200-day moving average. On my 1 minute, 2 minute, 3 minute, whatever chart, whatever I'm on, I have the VWAP that I'm currently looking at, okay? So that's where this is. Now, what does the VWAP do? What is the point of the VWAP? The VWAP, guys, is almost along the lines of the 13 EMA, where I showed you guys, IFMK, where I showed you guys CBIO, the flexible trend line. And what is the point of a trend line? A trend line is going to show us if that stock is considered bullish, right? Bullish, or if the stock is going to be considered bearish, right? That's the point of the 13 EMA. The VWAP is the same exact thing, only it's going to be able to show us that within the minute, 2 minute, 3 minute, the intraday chart. So if we're looking back at DMPI, what can we see? DMPI, this black line, What are we looking at? We're bullish. We're bullish. We're bullish, which means we're long. We can buy. We can hold. 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 We just went from bullish to now bearish. Now we're on the bottom side of the chart. Now we're seeing selling. Now people are again getting out of this play. So we're on the bearish side of the chart right now. So we're not doing anything that we want. We don't want to be in on this play. As long as we buy stocks on the top side of the VWAP, they have great potential of spiking on up. If we buy stocks on the bottom side of the VWAP, we're probably going to lose a lot as they're going to keep on going down. So the majority of plays I get into, nearly every play I get into, if I am buying it, I always make sure it's on the top side of the VWAP. If I'm shorting it, I always make sure it's on the bottom side of the VWAP. The VWAP shows us if the stock is currently bullish or if the stock is currently bearish at this time. Why would you buy DMPI right now? It's fading. It's on the bearish side of the VWAP. There's no buyers. Why is there no buyers? Because it's on the bearish side of the VWAP. Notice it holds as support, holds as support, holds as support, holds as support. Support's holding on up. That gives up. All buyers are out. But notice all the buyers are still in on this play, and you can get great bounce plays off the VWAP as well. VWAP will hold up as a very nice support line and a very nice resistance line as well. So DMPI, we'll keep this, or DMPI is a great example of the VWAP. As you guys can see, bounce play, bounce play, bounce play, bounce play, finally cracks. If it does come up to it again, it's going to hold up as what? Resistance. Old support holds up as new resistance, as we know. So the VWAP is an awesome indicator to always tell us if we should be going long on this play, if we should be shorting this play, or if we should probably just be staying away from this play. So things that we always want to be on top of. Now, these are, again, very popular indicators, and these are my top indicators. Again, those are the RSI, right? The Relative Strength Index. That is what's going to be as our oscillator, right? And those oscillators are going to be the ones that aren't on the chart, but right above it. I use the RSI, all right? Now, the other one, the overlays, I use the 50-day and 200-day. I use the 13 EMA. And then last but not least, I use the VWAP. So I use 4 different indicators while I'm trading stocks, okay? Now, I also use, again, the oscillator of the RSI to help me be able to figure out. But I don't really want to be doing much more than that. Now, why do I not want to be doing much more with that? Because then things start getting a little hectic. Then things start getting a little crowded, right? So it's not really what you guys want to be getting yourself into a lot of the times. Let's see, these are brand new charts right here. And let's see what we have. So if I wanted to type in, for instance, DMPI, right? I put in DMPI right here. So here's our DMPI. And let's go, I go to indicators, okay? So I go to indicators. What indicators do I want to be focusing on? Let me turn that off right there. And let's say, we have all these different options of indicators. So look at all these different options. There's so many, of course, different options. Let's say, okay, let's add the RSI. All right, RSI, nice. I like the RSI. We can use that, right? And let's say, well, I want to use the MACD as well. All right, so again, you can use the MACD as well. But let's say you want to use the clouds, and you're like, all right, well, I got to add my clouds. I love those indicators, right? And I got to use my moving average, right? So let's do the 50-day moving average. Let's put that in blue right here. Let's add that. Right, and then we also have our other moving averages that we have to add, right? That's going to be our red moving average. That's going to be the 200-day moving average, so we can add that right here, right? And then obviously, we're going to have our exponential, moving average. Deviation. Let's see if I can find it right here. If I don't come across it, it's all good. You guys know we'll be adding that. Let's put our volume oscillator on there as well. Right? And let's just say, well, let's use standard deviation as well, right? And let's make sure that, we're using our momentum indicator. That's, very important. Performance index. I want to know how good the stock's doing, right? I'm not a rookie. Let's go with our Q stick. Yes, come on. Obviously, we need that. A couple of zigzags here and there. Why not? That sounds cool, right? And look how, again, crazy it's getting. Right, our money flow option. It's like I don't even know at what point I'm even looking at this play. It's like what is even going on with this stock? Right? What's even going on with this stock at this point? And there we go. Let's add this last one. It's like, where do we even buy the stock at this point? And this is what some people do. And it's like, what are you even looking at this point? Right? They go too crazy with their moving averages. They are not too crazy with just their moving averages, with just the averages in general. And they have all this stuff right here. We don't need every single thing right here, right? Let's calm it down a little bit. Simple is better most of the time, guys. Have one thing and then calm down. You don't need a million different things that are just going to do what? Make it so much more complicated than what it already has to be, right? Make it simple for yourself. And that's why I usually say stick with 3, stick with 4 of your favorite indicators, but don't be adding 8, 9, 6, 7. That's just so many. There's so much right there. So definitely pull back a little bit if you find yourself looking at basically a chart and you don't even understand what you're looking at anymore. All right. So very important that you guys are not doing that. Let's dive back in on this and let's see what we have. So if we dive back in on this right here, whoopsie. We're going to go swap this. Oh, no, that's absolutely good. All right. So we dive back in on this right here. We just went to what? We went over all our indicators. And now why do I use these indicators? Why do I use the VWAP 13 EMA, 50-day moving average, 200-day moving average, and of course the RSI? As I already said, think about it. They are the most popular, right? If they are the most popular, they have the most strength. Right, a lot of times, guys, if you have your own super secret indicator, right? Let's just say some random indicator no one's ever heard of, or some moving average that no one has ever used before, like just using a 328 moving average. And you're saying, "Hey, guys, 328 moving average coming on up. Get ready to sell." And everyone's just like, "What's that guy talking about?" Right? Right? If you are, the one person out of 100 people using that only indicator, is anyone going to sell at your indicator? No. Why do I use the ones I use? Because they are the most popular. If there's 100 people, 85 of them use the indicators that I just taught you. And with that being said, we know now where the majority of people are going to buy and where the majority of people are going to sell. We also know where a lot of areas are going to be where things get a little bit more choppy. So these are why I use these indicators, because they are the most popular. Now, are there other indicators that you guys can use? Absolutely, right? There's all these different indicators, and that's the great thing about why you guys can paper trade and why you guys can try these out on your own. I don't want you guys to just say to yourself, all right, well, Deck taught us, kind of his favorite, but there's so many more out there. I get that. I taught you my favorite because they're also the most popular and also have the most strength. But is that saying that you can't use Bollinger Bands? No, not at all. Is that not saying that you guys can't use ADX? No, not at all. Right? You guys can go ahead, paper trade, see if that works for you, because it does come down to what works best for you. What is the preference? What has helped you guys be able to come out on top and be able to make the most money as possible? So that's going to be wrapping up our day 7 of boot camp, going over indicators. These are the indicators I use. These are some extra indicators. I hope you guys got a great understanding about that, and I hope you guys enjoyed this lesson. We'll be moving on tomorrow, day 8. Very excited about that, and we'll continue on with our boot camp every single day, rocking and rolling.